Welcome to the Founder's Guide to Bank Liquidity, a briefing document focusing on Q4 operations and capital strategy. This video synthesizes April 2026 Federal Reserve macro data with Q4 Section 179 tax strategy. The April 2026 SLOOS report confirms a structural shift. Banks are reporting tighter lending standards across the board due to a less favorable economic outlook and reduced risk tolerance. This affects C&I lending, NDFI lending, and the economic uncertainty is a major trigger. Bank friction operates through extensive and intensive margins. The extensive margin is the gate, focusing on approval standards. The intensive margin is the toll, focusing on loan terms. Even if approval standards are unchanged, banks are tightening the intensive margin with higher premiums and stricter covenants. The hidden cost of approval, particularly for C&I and NDFI loans, is applied directly to your operational agility. This includes higher premiums, stricter covenants that lock down decisions, tighter collateral demands, and shorter maturities that reduce the runway for credit lines. There is a timeline collision between Section 179 and bank underwriting. The IRS placed in services deadline is December 31st. Traditional bank loans have a 60 to 90-day underwriting and documentation process. This delay can push delivery into January, destroying your current year tax strategy. Traditional collateral requirements create significant weight. The Fed reality is tighter collateralization requirements. The operational drain means traditional lenders blanket lien your enterprise. The result is restricted cash flow, frozen secondary assets, and limited ability to pivot quickly for Q4 scaling. Traditional banks pierce the corporate veil by mandating personal guarantees to mitigate their own risk. This bypasses the legal protections of your corporate structure. The ultimate cost is staking your personal home and liquid savings on every equipment upgrade. The capital paradigm shift contrasts institutional banking with agile capital. Agile capital offers much faster underwriting, is optimized for Q4 deadlines, provides equipment-only financing, waives personal guarantees for qualified founders, and uses flexible, cash flow-based covenants. The Q4 founder readiness audit involves 3 steps. First, model the deduction cap with your CPA. Second, confirm vendor lead times for physical delivery by late December. Third, bypass the bank queue by securing agile, non-bank capital to guarantee funding clears before the IRS deadline. The Federal Reserve data is clear. Institutional gates are closing, and the December 31st tax deadline is approaching. Route your equipment financing through an agile capital desk. Protect your timeline, shield your personal assets, and lock in your 2026 Section 179 deduction. If you need agile capital to scale your operations and secure your Section 179 deduction, hit the link below and connect with the desk to get funded.